Hi all CY Mood followers. In today's video I will explain what is the famous quantitative easing or QE, and how this central bank strategy works in a simple and understandable way for everyone. QE took the international popularity during the 2008 subprime debt crisis in the United States. QE was created by the Federal Reserve in several tranches over the years. For now, the last tranche is the QE5, which was initiated in spring 2020 during the COVID crisis. This system is one of the central bank's weapons to encourage banks to make loans, both to each other and to their customers, companies or people like you and me. The QE was born because was created a block in the loan cycle, and we are going to see that in detail. The QE was a novelty in the US. It had never happened that the Fed had to work so massively in the economy. On the contrary, in Japan this economic recipe was used before to boost the economy. The principle behind the QE is simple. In fact, it serves as an incentive, or better, to push banks to lend money. This is in order to get the money parked into the banks into the real economy. Let's see the details. Banks can take money from the central bank at very low cost, but instead of lending to various companies in need of liquidity, banks invest in 10-year US government bonds. The lending activity is risky, the loan may not be repaid and therefore the money lost by the bank. Government bonds, on the other hand, are safe assets that have a yield, so the risk is zero and the gain is safe with the help of the Washington government. This kind of activity, if done on a large scale by most banks, creates an initial slowdown and then a blockage of the flow of credit, which could slow down the economy first, till creating a recessionary spiral. The Fed tried to avoid this situation by creating quantitative easing, which is nothing more than a pumping of money into the banks and then into real economy. First step, the Fed started buying financial assets directly from banks, taking financial instruments and derivatives of any quality, including many toxic assets, debts and derivatives. The Fed gave fresh money to the banks to buy their bad securities, eliminating some of the strong pressure on the banks. After that, the Fed started buying the American government bonds that the banks themselves were buying. This is because by increasing demand for this asset, the yield drops. With a too low yield, the banks are no longer inclined to buy the government bonds that now arrive at zero. So banks must theoretically turn to the public lending market in order to seek returns. This obliges banks to go back to being banks, to lend money to healthy, well-managed companies that will then return the money plus the interest rate. The Fed action has also lowered interest rates so that borrowing money is less expensive for the company or private individual in need of cash. We should also mention the problem of subprime mortgages granted in the real estate world to people who are unable to repay the funds taken. But I will dedicate a video to this topic in the future. But now we may have a problem. If this does not work, it means that billions of dollars have been pumped into the economy. This amount of money has depreciated the dollar. Depreciating the dollar means that US products are cheaper to buy on the market. But excessive depreciation causes the dollar to lose any value and become no more than a printed piece of paper. That means that no one would want dollars and there would be a possible currency crash, which is bad for the economy. Not only the Fed has used this strategy, but all the major central banks in the world. I hope you enjoyed this video and see you next time. Thanks for watching. Please subscribe and share our video to spread our knowledge. And remember to check all the product made for you by the CY Mood team.